All right. Hello and welcome to this month's monthly discussion where we talk about the markets and some current events that may affect your portfolio. So, this month, there has been obviously quite a few updates within the market that we want to cover. Primarily, I think a lot of the news that people want to hear is what we think of the Fed and their current announcements. In addition, we'll do a summary of 2022 sector highlights and then an outlook for 23 ahead. So, JR, do you want to get started?
Well, as we recap closing out 2022, it's been such a terrible year in so many ways. I mean, it's been historically bad in certain areas and industries and sectors overall. As you recall, coming in this year, we expected a tougher year overall. I don't think anybody expected as tough a year as it turned out to be. And a lot of it is just the Federal Reserve catching up to, mistakes from the last year or two of leaving interest rates too low or printing too much money. And with this chart, you can see what's unfolded this year, which is unprecedented. How many rate hikes, how quickly we've gone from zero to where we currently are with short-term interest rates. And it's caused a lot of the difficulty that we've all seen in risk assets and everything else. And really, I think the challenge that we've all seen is a lot of the inconsistencies out of the Fed, right? From a year ago this time, they expected to maybe start raising interest rates this month. And look what unfolded this year. So they had a lot of their predictions and forecasts just totally off base and left a lot of people with some big losses or difficult decisions to make this year. And even throughout the year, right? We've just continued to see a Federal Reserve that kind of changes what they're saying or what they're looking at, so you're trying to follow through. And I think if we recap some of those data points or issues Powell's had through his commentary throughout the year, just gives us a different tone of trying to follow. So with that, I think looking at the returns for the year, it's been a tough spot, Michael, on how things have unfolded this year and what's happened from a return on your money standpoint.
For sure. And when you look at the major indices, whether it's the Dow, NASDAQ, S&P, you're down 20+%, NASDAQ closer to 30. And what's also interesting is when you look at this year, what makes it unique is just how poorly the bond markets have also performed. If you also looked at the US 30-year Treasury ETF, that's actually down, about where the NASDAQ is. And again, you figure you're investing in safer assets, such as the treasuries, but that's really where duration really hurt us this year, especially on just looking at how the Fed raised interest rates so as fast as they did. So, again, when you look at it's from a overall perspective, it's, really where in the markets were you safer, where were you a little bit more exposed. And I know, again, just kind of going back to where the Fed is with interest rates, we've got up here the yield curve, where you're seeing, the 1 month at about, around a little less than 4%, when you peak at about 6 months, a little, between 4.65 and 4.7%. But that's when you really start to see, as the yield curve is dropping off further out, that you're seeing less faith in the economy. And that's one thing that is a bit of a concern to us, is that when you look, one thing that Powell did say was that when you look at the difference between the 6-month and the 18-month yields, that's where you can see, some of the recessionary indicators really come through. Because when that 18-month yield is much lower, that's just really a sign that within this time frame that you could expect or have a reasonable expectation for a recession.
Well, and Michael, on that point, let me read a direct quote from Chairman Powell from March of this year. Frankly, there's good research by staff in the Federal Reserve System that really says to look at the first 18 months of the yield curve, as he said, Michael. That's really what has 100% explanatory power of the yield curve. It makes sense. But if it's inverted, that means the Fed's going to cut, which means the economy is weak, right? And this is a direct quote from Chairman Powell in March of this year. And now, as we've seen the yield curve play out that we just looked at, you have this inversion that 100% of the time history suggests there's a recession ahead. and the Fed should think about cutting rates. Meanwhile, they haven't been consistent, Megan, right? I mean, they've changed from that speech in March to, other factors throughout the rest of this year too.
Right. And that's something that you touched on earlier, but I wanted to drive that point home because I think many of us are hanging on the Fed's every word, and rightfully so. Obviously, a lot of where they are driving does affect what happens directly in the market. So it does make sense. However, we wanted to pull just from a year ago where the Fed dot plot was, and that's where the Fed governors are ranking where they see the effective Fed funds rate will be through that period. So from the last meeting just a year ago, they projected for 2022 that you'd be somewhere around 75 bips. And you can see that quickly snowballed in the year of 2022. They effectively got there by May, and now they're almost 4 to 5 times that at this point. Now, if we go to the Fed dot plot from this past meeting, you can see that they're projecting next year in 2023 that we have a few rate hikes ahead. So while we do still see some tightening ahead, I think it also is fair to say to not necessarily hang on their every word. You obviously don't want to fight the Fed, but they do kind of change their course of action or redirect. And they did in such a short period of time, going from December of 21 to March, May of the following year. They obviously started to change their course of action very drastically based on the market conditions. And it's fair to say that that potentially could play out again into 2023, and that these projections could kind of realign either to the down or upside, depending on how the economy is digesting some of these future rate hikes.
And what scared the Fed? Right. And let's go back in time a little bit, back to the 1970s. And that's really where it feels like a lot of the pivot on conversation at the Fed occurred, where they're fearful that if they pivot or cut rates too soon, that inflation will come back too quickly. And they're using the 1970s as kind of the barometer. And Chairman Powell really wants to avoid being Arthur Burns, where Arthur Burns got criticized. And again, if you look at the chart here, this is from 1970 to 1978, the federal funds rate. In the early 70s, inflation got out of hand. So from 1972, they raised short-term interest rates from 4% to almost 13% in a short period of time to combat the inflation. What followed was the recession of 74, 75, and they pivoted quickly to cut rates back down because inflation had gone down, and to try to stimulate out of the slowdown and recession. And this is what the Fed is fearful, that if they follow what Arthur Burns did in 1970s, that they'll cut too soon or ease too soon, inflation will come back, right? And this is just interesting to go back in time to look what happened during the 70s and look at kind of what's unfolding today. So Michael, as we look at kind of history and what the Fed is doing, I mean, what should they be doing, I guess, from a policy standpoint, given all the work they've done on raising rates this year?
I think that they have to, first things first is that they need to become more consistent with their policy and look to reduce the overall chance of recessions. When you look at what's likely to happen, what's likely to unfold is we are going to see a spike in unemployment. Companies that are finally now able to adjust to where interest rates have moved. They've had a year of increase, so they can see how they're going to impact their future plans. That the Fed, they should pause. They should give companies a chance to breathe. And I think that moving forward, you need to just have it's better to have, I'd say, a longer stretch of higher interest rates versus, well, let me rephrase that, have a longer stretch of elevated interest rates versus a shorter stretch of much higher interest rates that lead to a more volatile period. Because if you have just a more consistent policy, you're going to reduce the chance at a hard landing, that you're going to reduce the chance of a severe recession, and that, at the end of the day, if we are headed to a recession, that if we can make it as shallow as possible, then that's going to be the best outcome for, not just companies, but for all individuals as well.
And I think, Michael, with that's the frustration, is the lack of consistency out of the Fed this year, right? We talked about the quote from March. If you look at some of the commentary throughout the summer and fall, Powell stated that if we get sort of a long sustained period of close to 2% inflation, that would be a sign to pivot. We've had 5 months since July of sustained inflation around 2%. Well, then a month and a half ago, they pivoted to back out service inflation as a sticky component within that. So half of the CPI is down, and that's positive, but they're ignoring that and focusing on the sticky part. So the Fed continues to kind of move what they're focusing on to continue to raise rates at the risk of the 74, 75 type of recession. Really, that's the concern the markets have with the drop we've seen this month in December and looking in the next year with the policy around the Fed. Because to your point, history, when you look at 50 or 70 basis point rate hikes, it takes a few quarters to figure out how much, quote, damage or how much impact that rate hike has on inflation in the economy. And the Fed just hasn't given enough time to see what's out there. On top of it, there was a recent study out of the Philadelphia Federal Reserve talking about the number of jobs that have been created this year, that it might have been overstated by 1.1 million jobs. And again, a lot of this challenge that the Fed has had during the pandemic is there's just a lot of inconsistencies in the data, and it's really hard to extrapolate and be very confident on where things are going for the last 2 years and the next year ahead. And really, that's the challenge, I think, facing the markets in a lot of ways, is the Fed is very confident on what they see, but the market, the stock market, the bond market, the yield curve is telling them otherwise, and it's consistent with what Powell's statement and quote was in March. The recession is ahead, and the Fed's going to have to cut rates. So it's just a matter of when.
And to your point, I think that's kind of a fair comparison of the current Federal Reserve chair and then Burns versus even Volcker. It's really a confidence erosion when they continue to kind of pivot what they're looking to with what their barometer is for when they're going to change their policy. And that's where I think Powell might be missing the bar on, is that his story has changed over time, and the erosion of confidence is what will inevitably hurt the outcome, as opposed to potentially what their actions are. Their actions may be in line with what could produce a healthy outcome. It's more just the erosion of confidence. And if they can get that under wraps, then we should be able to see a softer landing, to Michael's point.
Well, and the two sticky components to your point on the Fed right now is they continue to believe in this strong labor market and this service inflation being sticky. Those are the last two components, because in the middle of the summer, they were worried about housing inflation, the owner's equivalent rent showing up in the CPI. Now we haven't seen the declines in rent through the CPI numbers yet, but the Fed has already acknowledged that it's going to go down, and they're not worried about that anymore. So they're focused on two things. And the challenge we see ahead is the first quarter, you're going to see a lot of layoffs, right? The first week of January next year, the first Friday, you might see a negative job print that month. Will the Fed take that as a sign that the labor market has softened, or are they going to come out and say we need a sustained period of job losses before we pivot? These are the things we're going to look for into next year to decide kind of how to position given the uncertain and inconsistent Federal Reserve that we've seen all year.
And there's something to be said if they don't pivot just on the January number, considering most companies pick kind of towards between the end of December and then through January to reassess their personal budgets for the company. So most layoffs do tend to happen throughout that period. So they may need more than just that month specifically in negative jobs data to act on.
And on that front too, on the labor market, every week you have weekly jobless claims, which are people just changing from one job to another. So usually it takes a few weeks if you quit or if you're laid off. But over the last couple of years, people have been rehired very quickly. So the continuing claims have continued to decline. Well, continuing claims over the last few months are accelerating again. So what it's telling us is, as normal turnover in the labor market, you're not finding that next job very quickly. So the continuing claims of people waiting to find that next job is at the highest level since January of this year. And again, that's somewhat of an indicator of a weaker labor force or labor market ahead. And again, there's been no acknowledgement out of the Fed of that fact of the slack in the labor market that seems to be predicted within that continuing claims number. So Michael, as we're looking at, the terrible year, where are the opportunities, or how do we position given, kind of the traumatic year? And Megan, maybe we'll talk a little bit about what we might expect from a return standpoint, given how historically bad this year has been.
Sure. So I think that, going into next year, we're still having a bias towards value stocks as opposed to growth stocks, but also really we're looking at this at 2023 as being, the year of the bond, where you're able, between coupons that are being earned and recovery of principal, that you could see upwards of a 10% return year in bonds. And we don't think that's too far-fetched. And also, again, looking at what's done well this year versus what's done poorly, some of the S&P, from the S&P perspective, the biggest sector losers were communications, consumer discretionary, technology, and real estate, where your winners were, again, more on the value side of things. You had energy companies, utilities, and your consumer staples. And when you look at some of those numbers specifically, it makes sense with where inflation's been, that people aren't able to spend as much on the things that they don't really need, whereas your everyday items, whether it's milk, cheese, eggs, bread, household items, those are the things that really held up. And again, as you look at just those numbers, we think that until inflation comes down a significant amount, that's really going to be the areas that you still want to stay in 2023.
And looking at, it looks like we're going to close the S&P below 20%. If we look at history of a chart of the S&P closing down 20% in a particular year, what might we expect, Megan, next year? Obviously, it's no guarantee, but what does history say?
Yeah, I mean, history says, even including the 1930s, that 80% of the time following a 20% downturn, you will have a substantial up year. So it is pretty fair to say that we could see the overall market do pretty well next year. To Michael's point, we do really see kind of a transition into value from the growth sector. However, we did have this debate earlier, and I think it's a fun one, but also a good one to just kind of put into perspective. While the tech sector, for instance, has had a massive sell-off, this might be the time to get in for certain investors, definitely not for all across the board. And to say that it will be a quick win or that you will see any instant gratification also probably would not be fair to say. There's probably more turn ahead or pain ahead in the sector overall. But for people with a longer investment horizon at these levels, I mean, you're basically still locking in almost levels from 3 years pre-pandemic for most of the tech sector, whereas a lot of the other sectors are nowhere near that. So it's a great opportunity selectively for some investors to kind of double down on certain growth aspects of their portfolio if they're able to weather that storm.
Well, and you talk about the storm, Megan, when you look at history after a down year like we've seen this year, it's not like we're going to hit January next year and it's going to be a nice, easy climb up and it's going to be a great year. History would suggest that we're going to start the first part of next year pretty bumpy. And if you go back to 2008, that was a historically bad year. The market was down 25% by early March before it turned to finish well over 20% in 2009. Not to say we're expecting that type of decline to start next year, but the challenge facing what we've been talking about with the Fed policy, the likely slowdown of earnings of many companies and such, that's probably going to be a rougher start to the year. Having said that, if you're patient and look a little longer term, history would suggest that it'll probably be a relatively good year once we get through that bumpy patch to start the year.
Mm-hmm. And again, that's selectively. Overall for next year, we do see a larger shift into value. And I mean, we've seen some headlines, it's going to be the year of the bond. And I think some of us are very grateful to see those coming back in full force because it has been such a long period of low yields. where it was a little choppier getting a steady income from that perspective. So it's good to see that pulling back.
Well, there's no question, if you look at the silver lining of the traumatic year, is that interest rates are up, and moving forward, you don't need to take as much risk to get the income required from your portfolio, or the ability, if you're sitting on cash out there, you can get 4 3/4 to roll treasuries, which you haven't seen yields like that in over 20 years. So it's nice to see the stability of higher interest rates, which will help reduce the amount of risk you need to take in the overall market. So we're going to come out of this in a healthier market with the higher interest rates, because our view is you don't need to see the Fed cut rates dramatically. Let things adjust over time, and getting 6 or 7% interest rates on fixed income in many cases is not a bad place to be. Like you mentioned, Michael and Megan, the year of the bond. So that's just a healthy place to be, and you don't need to take as much risk looking to next year with all that as well.
That's right. And as we look into next year, outside of from the markets perspective, from the investing perspective, there are a few planning ideas that we have as well. The first of them being, when you look at just our cash management strategy, as JR was saying, you can roll treasuries at that 4 3/4%. Right now within the cash management, we're getting between 4 1/4 and 5 1/4%, where we're investing in high investment grade corporates, treasuries, and also, depending on tax status, municipal bonds. And just the overall structure of this is to ladder them out by 12 months. Then as the bonds come due, just reinvest those. And this has been a way for a lot of our clients to take some of the excess cash that's either been sitting in checking or savings that still isn't yielding too much, and really get a reasonable return off of that. And this is something that we have used for, I'd say, the past couple of years, when clients have, whether it's just keeping some cash on the sidelines, just keep it safe, or they've used this to actually plan for some other investments that they want to make. But this has been a great way that clients have been able to, just earn something a bit more than just keeping the money under the mattress, so to speak.
And right now there's a bill in front of Congress that looks like there's a high probability of passing this week, with some retirement benefit changes that could take effect next year, Megan. So if we look at some of those planning ideas, or some thinking into next year and beyond, there'd probably be some discussion there as well.
Yeah, so I think it was in 2020 they extended the required minimum distribution year from 70.5 to 72. The bill is set to potentially extend that to 73 next year and potentially beyond. The benefits are you can keep your retirement funds invested for longer to defer those taxes. However, there are still some potential opportunities to take distributions prior to that anyways in certain situations, and we can help kind of address where that would make sense to accelerate some of those before you're required to start, from just a tax planning, and then just from a keeping the funds in the family for longer over generations.
So with that, as we kind of recap the year in a lot of ways, and short-term looking ahead, it really has been a difficult year, but we've been through so many of these tough periods historically, and they're never fun when we're going through these down periods. But what we learned from periods of COVID or 2008, 2009, if you're matching and you have your financial plan and you have the cash flow from your portfolio, dividends and such, it really gets you through uncertain periods like we're in right now. And that's worked out reasonably well this year. And we think looking in next year, especially with higher interest rates, that's going to continue to be a good place to be. Having said that, looking at the opportunities on the growth side, some of them are probably going to get a little cheaper before you need to look to reinvest in some of those. And that's the long-term cycles between growth and value. We just continue to look like we're in more of that value cycle for a while. When it's time to pivot, we'll talk about it. So with that, we want to thank you for tuning in and wish everyone a happy, healthy new year, and we'll touch base next year.
Thank you, everybody.